I'm going to walk you guys through a little bit of a deck, and then I'm going to open it up to Q&A a bit about halfway through, because I've done this topic in the past, and I find the Q&A is where people tend to get most excited. So, name of this presentation is really around how do you raise what I call your grown-up round, so driving conviction. And one of the biggest questions I get, I love to meet entrepreneurs early. We tend to invest in companies anywhere from their kind of seed stage to their A stage, but I love to get to know great entrepreneurs as early as possible, because we as a firm I personally may make 1 to 2 investments a year, and so much better if I can get to know you in the early days, you can get to know me. I always say the most important relationship you have in your life is who you choose to spend your life with personally. The next most important relationship, if you choose to have a co-founder, is that it is like another marriage without some of the tools you actually have in marriage when things go wrong. And then the third most important is who do you bring in as your VC when you actually price rounds and form boards and kind of build a strategy for the future. So I think good for everyone to get to know each other early. And so one of the big questions I always get when I talk to entrepreneurs early are sort of what metrics do you want to see to write that, kind of bigger check? And I'm going to define bigger check as $5 million, but call it anything from an institutional fund where they aren't investing in a lot of companies. They're each investing in a couple companies a year. So you just went through my background. I won't go through more, but I've been between operating and investing, big company, small company, fundraising. I've been in VCs in 3 different cities now, so I think I've officially gotten old because I've stayed places for long periods of time. So there's really one thing when it boils down, when people ask me this question, what do you want to see from me in 3 to 6 months? There's one thing that actually drives VCs to write that that check from an institutional investor, and it's conviction. And everything else that goes into that kind of making a decision around that first check is helping that VC find conviction. But what I thought I would do is sort of like give a little bit of exposure to some of the comments you hear in a partners meeting that help you understand what conviction looks like or feels like. And they're usually things like, I got to know Emily way back in the day when she was at X company, and this woman just runs through walls. I've seen her do X, Y, and Z. She came to me 6 months ago when she was starting this company, and I've just always been so impressed with her. She's the kind of entrepreneur we have to back. There are all sorts of different ways that you may get to know a VC. Sometimes at conferences like this, I'm most impressed when I leave if somebody has gotten a card where they send me like just that perfect email, which is, here's what I do, here's why it's interesting, and here's what I'm going to accomplish in 6 months. And I don't want any of your time right now, but I'm going to try to steal your time in 2 or 3 months and tell you where we've gotten to. And by the way, things go terribly awry all the time, and it is of course you want everything to go up and to the right. But even if it's not up and to the right, understanding how you kind of interact with the things that go wrong is often as important as saying, oh, all these things went right. This is the slide that you need to have in one of these presentations around the Series A crunch, which really isn't a Series A crunch. What this slide shows you is that it really is the number of firms and companies getting funded at the earliest stage that's increased dramatically in size. So there are about, I think the actual stat, this is fund data here, but the actual stat is something like the number of $1 to $2 million financings has increased 7x over the last 10 years. And here you can see the number of seed angel funds has basically doubled over the last 6 years, whereas the number of firms that write those kind of typical Series A, Series B type checks has been relatively consistent. So many more companies are getting started and getting that early stage of funding, but the same number of companies are getting that $5 million plus check, $3 million check, that range. And so that's where the crunch is felt. But there really are the same number of companies, maybe a little bit higher, getting funded at that phase. So, I think I heard a little bit of the last speech, but to a little bit of what he was saying, don't worry about everybody else. Don't worry about, am I a unicorn? Am I a this? Am I a that? And, is there a Series A crunch? Just build a great business, and have conviction around what you're doing, and and just try to block out the noise as much as possible. As an entrepreneur, I can tell you, I used to literally not read the press when I was at my best, other than one day a week, because it really gets into your psyche. And if you build a good business, there will be money for you. So just a quick definition, who are these institutional VCs that write these $5 million plus type checks? So usually it's firms that have a fund size of kind of $200 million plus. These are firms that reserve significant capital for follow-on rounds and, oh, by the way, in down markets, which we may have one of these days, have the funds to support you through the hard times if they feel like you are doing the right things and setting yourself up for success. So one question that probably very few entrepreneurs ask, what do you reserve for an investment like this? What happens if the world falls apart and I have no business model and you tell me that's fine right now, but in a year no one else actually thinks it's fine? So I think it's an interesting question that you may want to ask towards the end. Partners make up to 2 investments a year. That's a rough number. There might be some years where you make 4, some years where you make 0, but it's not consistently each individual making many investments a year. If you just think about the amount of time one partner spends on a board, you really can't handle more than 10 companies, and you get to 10 over 5 years if you have no exits. And we really look at board commitments as a 7 to 10 year thing. I just invested in a company in DC. I've lived and worked in many cities, and DC is not one of them, but I just fell in love with this company, and the biggest decision I had to make was, am I committed to DC for the next 10 years? And that was a real thing that I was pushed on and I thought about, because if and when things go wrong, and they almost always go wrong, you're on a plane to that city, every week sometimes until things are in the right place. So I'm really tired of this term unicorn, and I have 3 daughters, and we really love unicorns in my house. But I say it to relieve you of the term. 0.1% of companies in the last 10 years have become unicorns, and on average it's taken them 7 years. And we don't know if many of them will actually end up being great businesses. Some of them will be amazing and will return more money than all the ones that lose money. But the short version is, we spend a lot of time talking and obsessing about them. As an entrepreneur, don't worry about it, put it out of your head. However, if you haven't built a company that's had a success, then you're operating in the world that most of us operate in, which is, how do I raise my capital? How do I build that connection to a firm? And a lot of what we talk about at Upfront is build lines, not dots. So what that means is, don't approach the firm that you think you might want to invest in a month or even 3 months or maybe even 6 months before you want to close the round. Find a reason, an excuse to get on their radar screen, build credibility, build a pattern with them, build that line where you have multiple touch points. Build it in as time-effective way as possible for VCs, because VCs are the busiest non-busy people in the world. But build that relationship and be pretty targeted about how you are who you're reaching out to in a firm. Is this a partner who likes this kind of stuff? And how you kind of can build those touch points over time. And then finally, metrics do help, and I have a whole second part of this deck I'm not going to get into, but I'm happy to answer questions around what are the metrics that most matter to open the door and close the door. I like to say metrics open the door, people close the door, because again, until you get to that growth stage, the really big checks, the metrics are a blanket. It's a comfortable. It's a comfortable blanket that makes you feel good about an investment when you're still very much just, kind of betting on the team. And then I think we're close to my last slide before I'll open it up to questions. These are kind of like, the pyramid of things I think, I would recommend to you guys to think about as to how to raise that $5 million round, right? Build a strong narrative. It's always better if you have a relevant background, particularly now. There's so many entrepreneurs starting businesses that are marketplaces for painting, and they've never painted a house in their life. And it's not totally necessary, but if you are doing something in a space where you don't have background, maybe find a co-founder who does. And interesting market. Again, I sort of look at markets as how do you think about them, why, and how do you dominate, at least, even if it's a small market, how do you dominate it and move out from there? Then execution, all of the stuff, fairly obvious. I think the getting warm introductions is a really, really key piece of getting to VCs. Very few will take inbound or cold calls, and there's almost always a way to find your way into a VC you really want to talk to. And then the metrics certainly do help. But if I were to tell you like the real version of the slide, it's get competition for your deal, get some good PR at the right moment in time, get some vanity metrics that can open, a number of doors, and like everything in life, as soon as there's competition for your opportunity, everyone else becomes a lot more interested. And then, finally, this is a high-level slide on metrics, since it's the question I get the most often. And, sort of the way I look at, I guess, this slide now is pre-market is sort of like pre-seed. 1 year post-launch is kind of what we would call seed. And 2 years post-launch is probably what we'd call A, roughly. And in the earliest days, I think very often the most important metric is how obsessed are you with your customer? How often are you talking to them? What kind of feedback are you getting from them? Why do they love it? Why do they hate it? So, I think sort of some companies actually lose sight of that customer obsession, and in the earliest days, they will tell you everything you need to know. And then as you move along the spectrum, it turns into more and more questions around team and metrics and those sorts of things. So with that, I'm going to stop and not go into the specific kind of metric slides because it gets pretty granular, and some of you will be interested in consumer and some in SaaS and some in other things. And I'll open it up to questions. Well, no, it's a really good question and a good point. I'm obviously not sameness in ways that the industry likes to talk about a lot right now, and it's something I think a lot about, having been a junior VC back in the day at a firm in Boston and then in the Bay Area. But to some extent, I think you do need to get more diversity into the ranks of VC partners, and it's a strange field where the feedback loops are very long, right? When I went back into VC and I went from looking at my Google Analytics dashboard every morning and seeing how I did to, wow, you're not going to know how you're doing for 10 years. It's just very long feedback loops, which means the industry is a little bit slower to change. But I think I think a lot of the conversation now is creating a real awareness around that. And I also think when the environment becomes a little bit less heated, which it inevitably will, whether you think we're in a bubble or not, people tend to move less like sheeps and move less, kind of around fear of missing out, and really kind of look within and figure out what they think is a good business. But you do get diversity. People come out of different industries. People have had different issues operating as an operator in different moments. People resonate with different personalities. Probably the biggest thing I think about is sort of what makes a good pitch in a partner meeting and what makes a great operator, and when do those things not line up. And I think that happens a lot, and it's something I'm at the early phase of thinking through. But ultimately, I think it's for sure a real issue. And but I think there's an overt effort with the focus on the number of female partners, the number of minority partners, et cetera, for people to identify their cognitive bias and make changes around it. And the only final thing I'll say is that, I think we at Upfront look for contrarian a lot of, and I spend most of my time, well, I shouldn't say most of it, I probably spend half of my time investing in LA and half everywhere else. And when I go to the Bay Area, I'm going to assume that most companies, if they get to me through some sort of informal channel, that there's something wrong with them, because there's enough capital up there that they shouldn't get to me. But there are specific places where companies should get to me, and they tend to have a lot to do with a unique view of the world I have or a background I have. But one of the things we definitely look for are companies that may fall into a blind spot of other VCs and something that feels very contrarian. And I think there's a subset of VCs that definitely feel that way. So good question. I think a couple of things. I think one, picking co-founding, like a co-founding team that has worked together in the past or knows each other very well, went to school together, something where you have some experience moving through hard times and figuring out decision-making structures, et cetera, is something that I think is generally something I look for in teams. It doesn't mean it's universal, but I'd say that's number one. Resilience is just a huge one. I think we talk about, we've had, I think, close to $15 billion plus exits over the last 20 years, most of which, actually all of which I'm not responsible for, because I just came back in recently. The universal thing, if you actually dig beneath almost every company that has had to struggle, has had to build a big business over many years, which is what happens 99.9% of the time, they always go through real significant problem points. Co-founder issues, missed product launches, high burn rates, whatever you want to call it. And so that ability to kind of pick yourself up and keep going and take lemons and make lemonade and realize that being an entrepreneur is really possibly the best and the worst job in the world, and push through, I think is a really important one. And then I think keeping internal compass around just how to build a big business and what really counts and what really matters, and kind of removing the noise from the signal. And sort of it's that perfect combination of shiny object, big vision, I want to conquer the world, HBO Silicon Valley style, but here's how I'm going to conquer it in the next 12 months, and all of that is noise. And because for sure, the best and the biggest companies are constantly expanding their scope, but in a sort of methodical manner, and are saying no more than yes, and have sort of ruthless prioritization. All right. If no other questions, I think actually we're kind of at, one more. Sorry, can you clarify? Oh yeah, so it's interesting. Today more so than ever, being able to come across as compelling in a partner meeting and in a fundraising environment is a key strategic skill set. And the greatest challenge that we have at times with companies are that they're actually great companies, great operational companies, but they don't sell in that room, or they don't in a way that gets the dollars in. And unfortunately, for better or worse, and this is why actually sort of a little bit of a rationalization around the economic environment, which means things that sound maybe awful to entrepreneurs, but lower prices, more ownership for VCs, more capital efficient structures. Those things are actually good for good, solid operators, because today so many, raising capital is so strategic, because you're competing against bigger marketing budgets of teams that have raised that capital. And so I don't think there's a particularly good answer. I would just say that sometimes the people who are best at selling in that room and kind of hit that standard, this is what a top shelf VC backable team looks like, they don't always operate in the way that one needs to operate. And it's a really hard skill set in the early stages of a company, right? Because you have to ideate, love the customer, build this company, and then most companies scale from 1 or 2 people to many more people in a year and 2 years and 3 years, and those skill sets can be really different. So you're also constantly self-improving and trying to figure out how to make yourself better and better. So it's only to say that I think I really try to understand the psychology of the entrepreneur. So I try to get to know them over longer periods of time. I try to understand if they know what their blind spots are. I try to figure out, kind of how they want to grow the team, where they want the most help. I think a general self-awareness around where they are strongest and weakest from an operational standpoint, because you can obviously tell whether they pitch well pretty easily. And sometimes I'll be very interested in companies that just pitch okay, as long as they're open to getting kind of feedback and coaching as to how they could pitch great. And it's a sensitive area, so you only kind of want to give advice when people want to take it. So that's generally how I see it. But it is a place where maybe I'm a little bit different than the standard stereotype, where I will often like companies that are just okay at pitching, who I have some data, information, exposure around, are really great at building and managing teams and growing businesses. All right, thank you guys.